So good afternoon, and thank you for joining this afternoon's Cuppa Club with Craig Pennington, CEO of Salad. My name is Jerome Heusinger. I'm Senior Development Manager at FX, and we are supporting Salad's fifth bond offer on the platform. Before we get started, there's some housekeeping to do. I'd like to let you know that the Cuppa Club is recorded and made available to watch, and we also edit this to a highlighted version. I need to tell you that this is not a financial promotion, and if you do need advice, please talk to an independent financial advisor. The Cuppa Club usually runs for 30 to 45 minutes and is an opportunity to meet Craig and ask him questions and hear about why Salad is such an impactful organization, what it's done, what it plans to do, what investments are funding this offer of funding, and the challenges and opportunities. Please feel free to ask questions in the chat box. We've already received a few, and we will take questions as we go along. Just before Craig introduces himself, a little bit about the bond offer and what it's supporting. Following 4 successful previous raises on FX, Salad has launched a new, if ISA eligible, 8% offer that will provide further lending capital, helping more people who are locked out of mainstream finance by poor or non-existent credit scores to access fair, affordable loans and avoid high cost and illegal lenders. So, Craig, please offer some introductions, top line explanation of what Salad does.
Thank you, Julian. So welcome everyone to the FX Cuppa Club. As Julian says, I'm the new CEO of Salad. Salad takes a different approach to affordability assessments. We use open banking data. We don't use credit scores because we believe that many people are penalized by life events that have happened previously. Those negative markers on a credit score mean a low score. If you're young, you've never had a credit product, you have no score, you have no credit footprint. And we believe that we allow those people who are either not served or underserved by mainstream credit access to fair and responsible lending. And that's our mission. And our track record has shown that by taking an innovative approach to data analysis, it is possible to lend responsibly to those individuals who are ordinarily declined. A bit about me. I spent most of my career in the city. I worked in financial services. I left in 2015, having made the decision to do something with social impact. So I spent some time on a family business. I've worked for a charitable foundation on their social investment initiative. I've been a trustee on numerous charity boards, volunteered at a food bank. I volunteered for Crisis. And then I joined Fair for All Finance, an organization some of you may have heard about. They're actually an investor in Salad. They get their money from dormant asset funds, so bank accounts that have been left dormant, no one claims them. They go into the government, and the government allocates money to organizations focused on social investment. And Fair for All Finance has that mandate exclusively to look at financial inclusion. And so it was at Fair for All Finance that I became familiar with Salad. I was the board observer. I was responsible for managing Fair for All's investment in Salad. And I actually was offered an opportunity to join Salad in the middle of last year. So I joined as the chief strategy officer. And they didn't really have someone looking at strategy full time. And so they wanted to have somebody with the capacity to do that, with experience across the sector. So whilst I was at Fair for All Finance, I was responsible for all the CDFI, Community Development Financial Institution investments. Salad is a CDFI, and also other community finance organizations, including credit unions. So I brought a lot of background from what community finance was doing, but also other non-commercial lenders that also work in personal unsecured credit. And I think, I applied to become CEO. So Tim Rooney, our previous CEO, left the firm, and he decided it was time to step down. Salad was very much a startup. over the past 7 years, and it's become a medium-sized company now. We've got a 100 million loan book. We've got 55 employees. And with that comes a different approach to running the business and a different approach to growing the business from here. So Tim, I've taken on the role. And why am I excited about Salad, and why did I join Salad after my time at Fairfield Finance? Salad has been almost unique in the CDFI personal lending world at proving the concept of it is possible to view people differently, take a different lens for their credit affordability. And Salad had a vision from the founder, Alan Campbell, and from the original executive team to use technology to better assess a person's affordability and their likelihood of repayment. And that has led to significant growth, Salad being the largest personal lending CDFI in the UK. And that is a great achievement. And it's a model which we want to grow further from here.
Thanks, Craig. That's a really good intro. It's really interesting that you mentioned this sort of evolution from startup to greater maturity. But despite that, as you say, Salad is still the largest personal lending CDFI, and arguably the most innovative as well. And I think this is much underappreciated. Could you discuss that in particular with reference to your recent King's Award for Enterprise for Innovation?
Yeah, very good. Good question. Yeah, I think being able to take a different approach, to prove that that approach works, and to provide access to credit through, we don't really ask different questions of our applicants. We just use different data and different analysis to come to what we think is a better use of analysis to assess the affordability. So it's machine learning, it's AI algorithms. So we take our huge experience of having lent, and that improves the model over time, and we can lock in those improvements. So it's like a cumulative effect. I think your point about us being far bigger than a lot of our peers in the CDFI sector is true. I think some of that is we took a different approach. We didn't have, some of these organizations have been around for a long time. Salad's only been around for 7 years. We didn't have the issues of legacy platforms, a book of perhaps loans that weren't performing very well. So we had a clean start, and that has been an advantage. But going to the King's Award, yeah, this was awarded in March this year. It is a huge achievement to be recognised this way by such a prestigious organisation, and we believe Salad is the only lender of its type to receive this award in its 60-year history. So it's an award for innovation, and it is recognising our innovative use of open banking data and our Crouton model, which assesses a person's likelihood of their repayment. So it's a huge achievement, and the team at Salad are very proud. And you'll see the logo on our website and on the FX video, and there'll be some other PR related to this as the year goes on.
And many congratulations.
Thank you.
So, following in the same vein of startup to growing into greater maturity, and this will also blend into a question that we've received from Janet. So what we'd like you to talk about perhaps is what will Salad look like in 5 years' time? And specifically from Janet, what will the next growth phase look like? What is your ultimate aim? Will Salad remain standalone, or will it seek to persuade larger financial organizations to adopt and promote the services it's pioneered?
Great question, Janet. In summary, Salad in 5 years' time, bigger and better. But don't worry, I'll go on to answer the question in a bit more detail than that. What do I mean by that? Well, we want to be serving more customers in financially vulnerable circumstances, and we want to be sustainably profitable. We haven't, to date, as you'll see from our financial reports and accounts. We haven't been sustainably profitable. We've had profitable months, but on a cumulative basis, we have been loss-making. And part of my role is to change that and to make sure that we are generating a profit on a sustainable basis going forward. Because if salad doesn't exist, we don't have the impact that we have. Our social impact will be zero. So it's of key importance to get to a point of sustainable profitability. Now, is there a role for mainstream finance and larger organizations to play in that? I mean, I'll be honest, we have spoken with high street banks, for example, about referrals, their customers who they don't provide credit to being referred to us. To date, we've not managed to secure any sort of concrete arrangements going forward. Uh, they have different incentives than we do. It's not necessarily a customer group they understand very well, but never say never. We continue to have constructive dialogue. I would like to think that our technology and our approach to loan decisioning can be applied to millions of people that don't really reach salad today, and mainstream finance and other non-bank commercial lenders would be interested in getting referrals.
Okay, thank you. And there's another question from Janet, and I'll come on to that because it combines with a wider issue. So your last bond offer on FX closed well over target. Can you tell us how that investment is being used and what impact it's created? And then the question from Janet is, why another raise so soon after the last one?
Well, the FX4, so the fourth raise that we did on the platform, that was instrumental. So we increased our senior debt facility, but for every pound increase in the senior debt facility, we have to fund an element of the loans that go out there. So that raise was critical to allowing us to access that increased debt capacity. So all of the raise has gone out, it's been lent out. Some of it's been recycled, given the short-term nature of our loans. And that has been providing access to people who ordinarily might have got declined. So the funds there, the proceeds have been put out there. So the impact is people are not having to resort to higher cost alternatives. They're not having to go to loan sharks. In the application process, they have benefits that have been identified that they could claim that they're not getting today. So hopefully we've provided a lot of financial resilience to people who otherwise wouldn't get it. Why are we raising money again? Exactly the same reason. I mean, in terms of why we're coming again so soon, ordinarily the gap between our raises is shorter, but we've been very busy. There's been a CEO transition, and so we haven't. It's been a little bit longer between the fourth and the fifth raise, but the reasons and the proceeds, the use of proceeds is exactly the same. All of it will go out for lending. Thankfully, we don't need to have any of this investment used to cover costs. It all goes to lending.
Okay, and we have a question that's just popped up, which is a question that we have received and that you have discussed with reference to each of the previous four. It's about APR. So let me just read it out. And thank you, WD, for submitting this question. My question is, credit unions think that your loans APR is outrageous. Why shouldn't I just put my funds into a credit union instead if I want to help people access finance?
Yep, a very good question. And I would say that, our representative APR is 79.5. Credit unions are prevented from from lending money above, I think it's 41.6 on the regulations. So yes, there is a material difference. However, I would say one of the reasons why credit unions can lend money at that rate is they have savings deposits, which means their cost of capital is very low because they have a base of deposits they can use to lend out. We don't take deposits, we don't have savings accounts, so we have to raise money like this and through other means, and we have to pay more money for our capital. I think more importantly, though, although our representative APR is 79.5, if you continue to borrow from Salad, it is possible that the APR that you will be charged is 59.9. So, we do recognize if there's good repayment history, we offer additional loans at a lower APR, going down to 59.9. My experience of credit unions, and they do a fantastic job in their local communities, but my experience of credit unions in terms of who they typically lend to, they often use credit scores as part of their loan decisioning. I would, and we've known that when we've looked at in my experience before working at Fair for All Finance, I have looked at the lenders, the typical customer of a credit union. Because they use credit scores, they typically do not lend to the people that Salad is lending to. So in summary, we have higher costs than the credit union in terms of our cost of capital. We have higher defaults because of the customers we're serving, but um, credit unions don't serve a huge proportion of the customers that Salad serves.
Okay. Yeah, thank you. I was going to say, and I guess the proof of the pudding lies in the fact that Salad has not yet made significant profits, which is the trajectory looks positive over the next few years, and that's within the offer document. But yeah, and that is partially explaining the APR. Could you hang on? I'm just Richard Hancock has asked a couple of questions. Is the basis of your model that you ask more questions of potential customers to assess their creditworthiness, which means that your profits are reduced, but you are able to lend to more customers?
Yeah, I think returning to something I think I said earlier, it doesn't matter. All credit lenders ask pretty much the same questions. What's your income? How much debt do you have? What's your essential spend? Indeed, some lenders don't even ask and look at what your essential and non-discretionary spend is. They just look at your postcode, look at some government data, and assume you spend just like everyone else who lives in your postcode, which that data is out of date and it absolutely does not necessarily reflect your spending patterns. And so our use of open banking gives the precise view of someone's income and expenditure that is not reflected elsewhere. So again, we ask similar questions, we look at similar variables, but the data we use in conjunction with other sources of data, such as CCJs, over 25% of our borrowing base have got county court judgments against them. If you have a county court judgment against you, that's an automatic decline from other lenders. But we will lend to people with a county court judgment because it could be something as basic as a car parking fine you didn't pay 5 years ago. So it's the use of data, but we are asking very sort of similar questions.
I want to kind of head back to this APR question, perhaps by discussing a typical Salad customer and what the alternative might look like for them in terms of high cost or illegal lenders, and how the economics of that would look different to taking out a loan with Salad. And if you could also perhaps quantify how many people are in your scope, and that might be useful. As opposed to, it's hard to go. There are many hundreds of credit unions. They do a fantastic job, but I think we need to sort of differentiate more between your target market, if you like, and that of credit unions.
Yeah, I think we've had referral schemes from credit unions where if the loan amount was less than £2,000, they would refer them to us because they didn't offer a loan of £2,000. But for customers, So Salad's typical customer, the male female split is roughly equal. They are there's a lot of single parent families, and where that's the case, it tends to be a female parent. They are people who earn the close to the national living wage, but they can also get benefit income as well in receipt of that. So things like universal credit. We tend to have more public sector customers than the national average or the population at large. And the vast majority of our customers, over 80%, are renters. They don't own their own property, they rent, be it social housing or private landlords or council housing accommodation. So they live to their means. They anything that is unexpected, an unexpected event or expense, it throws them off course. They need to seek credit with a short-term fix. And not all of those events are actually life-changing events. Some of it is as simple as repairing a car or replacing a broken washing machine. Um, I think the alternatives, so we see that because we have open banking data, 70% of our customers on our loan book today use high cost short-term credit. And by that, I mean APRs in excess of 100%. And unfortunately, a lot of the same names come up with our customers, and they're regulated entities, and they charge APRs in excess of 1,000%. And why do we look at that? I mean, we look at that because the fact that they're paying such high levels of interest on the debt outstanding means that that's a credit risk to us. So we have to make sure that they're not overly indebted in absolute terms, but also not relatively overly indebted to lenders that are charging APRs of over 1,000%. Then if you start to talk about friends and family, friends and family don't assume it's interest free, don't assume it's friendly, and the consequences that come with that. I mean, loan sharks remain very prevalent in the UK, and people are paying not even financial, but they're paying mental health consequences of having to resort to that high cost alternative.
Thanks, Craig. So just to stay broadly, well, no, I guess it's slightly outside the subject, but Chris has sent an interesting question, which you've been asked before. Your forecast return is 8%, higher than most microfinance investments. How do you answer the accusation that you are benefiting people who are wealthy enough to invest at the expense of those experiencing financial hardship?
Well, we recognize that, as individual investors, you have a, a whole raft of alternative investments that you could access. The 8% interest payable on this bond is our cheapest form of capital in our capital stack. We have to pay, unfortunately, more money to other investors in the capital stack. They're institutional investors. But it's the role played by you in investing in these bonds is to allow us to leverage that capital that we have access to in say, such that an £800,000 bond is the catalyst for leveraging tens of millions of pounds of lending to customers in financially vulnerable circumstances. Would we like to pay lower interest on this bond? We'd love to, but we'd also like to raise the money. And so, given the alternatives that you could invest in, we feel that 8% is appropriate.
Can I jump in there? I mean, this is your fifth offer. We started at 10% because Salad was then relatively smaller, relatively not as well known, and further away from that financial inflection point that we've been talking about, that we talked about earlier on. I'd also emphasize that this instrument is junior debt. It's not secured. And under normal circumstances, as it does for many of your other creditors, that would require a higher premium. And the way we look at it is that we look at the sort of risk-free rate, which is arguably the 10-year government bond yield in the UK. That's 4.7%. And we would argue quite strongly that a premium of 3.3% above that is very reasonable.
Yeah, I completely agree
Yeah,
with you, Jeroen. I
yeah.
think it's reasonable. And also to your point about where we've come from, we are closer to that inflection point in profitability. We are of a significantly larger scale. Um, we have a track record of growing lending well, and as such, that all of the above should be reflected in a lower interest rate on this raise.
Okay. Could we move on to general macro and then another question we've received from Richard? Look, uh, the macro environment is quite tough. There are all sorts of anecdotes around this. There's a little bit of political uncertainty, what happens to the welfare budget, all that kind of stuff. But in that environment, specifically to Richard's question, are you going to share information on default rates? Richard's memory from recent email is that by and large, your loans get repaid. I've not checked my memory against the email.
Yes. So let me talk about the macro environment in general. Even before the conflict in the Middle East started early this year, we had, as a board, taken the decision to slow loan originations in 2026. That was a decision taken proactively at the end of last year. And that was to pause, to invest in the platform, to be ready for subsequent growth. Um, and we continue to believe that was the right decision. And it's important to focus on a profitable organization, not just growth for growth's sake. So, but there's lots of uncertainty. You know, fuel prices are going up. The regulators have already announced a higher, fuel bill down the line. That said, if we look at our early month arrears, and most loans that do go bad tend to go bad in the first half of their loan term. Our early month loan arrears are actually all trending below the last 12-month average, which is a great sign, and it's, testament to our strong credit loan decisioning and our credit management. But we are mindful that, there could be more negative developments down the line, but let's hope that things in the Middle East have turned a corner. But who knows? You never know. To your specific point about default rates, Richard, the gross loss rate on the portfolio. So if you take the defaults as a proportion of the loan book, they remain in line with our historical averages. So you are correct. More loans get repaid than default, and that is shown by our loan book profitability, and hopefully reassures everyone that we're doing a good job on credit decisioning.
Okay, thanks, Craig. How will an investment in this bond be repaid? Because obviously it's the fifth offer, and there are four out there that need to be repaid. And to what extent is the 3-year term more challenging for you than the previous four offers, which were 5-year terms?
So what Salad, as I mentioned, Salad is generating a profit from its loan book, and that profit continues to improve, and that profit is partly recycled into further growth in the loan book, but also it provides a source of funds to repay previous investments and bonds raised on this platform. I don't think 3 years is necessarily more challenging than 5 years in terms of a bond repayment schedule, because we see this platform very much as being supported by investors seeking a social and financial return, and that means that support is great, and it means that we can return to this platform on a regular basis. So you shouldn't be unsurprised to see Salad returning to this platform on a regular basis, because it's an important critical source of capital for us. As I said before, it's a relatively cheap source of capital for us. and we will be raising more money in the future. But the key issue is the loan book profitability is such that we can afford to repay those loans when required.
So you mentioned earlier on that the quality of the loan book, if anything, is improving, which is perhaps counterintuitive in this environment. Does that mean that your rejection rate has gone up? First question. And what about the people who don't qualify for a standard loan? How do you support them? We've read about no interest loan schemes and partnerships that you have, such as Step Change. Could you talk a little bit about that?
Yeah, so our accept rate has not really changed a huge amount over the last 12 months. I think the lower arrears rate, the early month arrears rate I mean, it's a great dynamic and speaks to our credit risk control. I guess we perhaps have been more negative about the macro outlook at the start of the year, expecting to experience a bump in the road, but all data would suggest that that's not what we're seeing in the loan book, front book or back book, loans that we wrote in previous years. So that is something which we hope will continue to be the case. To your point about what do we do with people who we decline, we recognize that's a big number, and we think we should be doing as much as we can for our declined applicants. It's part of consumer duty. The key things that we've done to date have been signposting, as you mentioned, during the connections, the link to Step Change. So they will help people who've got excessive debts in terms of rescheduling payments and managing that situation. We have links to Money Helper on the website for provision of immediate financial support through local organizations as well as national organizations. We've also introduced an initiative very recently, which is that Salad is a lender, but we also have a credit broking license. And that has allowed us to, if we decline someone, well, firstly, if they're a marginal decline, there is a scenario under which we can offer them this no interest loan. The funding comes from Fair for All Finance. It is interest free. There's a small cost of capital that we have to pay for the scheme, but there was a pilot run over 3 years. A report was written recently that said it was that it's hugely beneficial. It's that little step onto the credit ladder. And so we're the only lender in the UK that does this scheme now, offers these no interest loans to the marginal declines should they meet that criteria. But what the innovation we've introduced recently is that if you're declined by Salad, so we can't lend to you responsibly. If you've consented, we send some of your data, to a panel of lenders which we've curated, and they might give you an alternative offer. They may be a series of offers. And the key things that we've done in curating this panel is the APRs are below 99.9%, so it's not high cost short-term credit. We've screened all the lenders to make sure they don't have a high false complaint rate, for example, with the financial ombudsman. We screen their accounts to make sure they're financially sustainable. We have screened their owners to make sure there's no sort of reputationally questionable ownership behind them. And as such, we've got this panel, and our customers are being faced, or our applicants rather, are being faced with a situation where we might decline them for our reasons, but there might be someone else out there that is willing to accept them. So that program recently launched, and we're hoping that it will improve our overall accept rate in terms of people getting credit, and not necessarily the Salad accept rate.
Okay. And another question, and I'm nearly towards the end. So could we go slightly beyond the mechanics of just lending and talk about financial well-being, which is a concept that you mention frequently in your materials? Could you explain what that means in practice and how your tools and the open banking approach may help customers build lasting financial stability, not just access alone?
Yeah. I mean, I think access is the first part of that journey. Um, if you're in a situation where you can't buy your children the school uniform when they start school in September, and you have your it's a mental health crisis. It's stress on the family. It might have a negative impact on family relations. So just at its basic level, having good financial well-being and resilience is about people having access to things we don't even think twice about. We've got most people on this call will have savings, they'll have a credit card, they'll have maybe an agreed overdraft facility. We don't ever have to come across those situations. But what Salad does for the long-term health of our customers is we've on providing that access. If you have a successful repayment record of our loan, we report that loan to three credit rating agencies. It will positively, and we've shown it in the data, it will positively impact your credit score, all other things being considered. In time, your credit score can improve such that you may be able to access more affordable forms of credit in the future, tools such as a credit card, agreed overdraft, or a cheaper source of unsecured loan capital as well. So we would love to be able to say Salad does a job and then we can just sort of wave you off to mainstream finance. It is a bit of a long journey, but we are able to get people on the first rung of that credit ladder to improve their credit score and to provide them long-term access to cheaper forms of credit for decades to come. And the value of that proposition is substantial.
Okay. I'm just looking. I don't think we've got any more questions. Craig, thanks very much for everything you've said, all the questions that you've answered. And if anyone has any other questions, please send us emails or what have you. But Craig, do you have any final words? And what I always think about in terms of impact, because investors on our platform are motivated by social impact. And one of the aspects, one of the ways to question impact is what is the counterfactual? What would the world look like without salad? Because I think that's an interesting way of viewing impact. So if you could have a go at that and give us some final thoughts.
Yeah, I mean the impact stats. In making our loans available to people at our sort of typical loan size, we're saving them circa £500 in what would be additional interest costs if they go to higher cost alternatives. And by that, I don't mean loan sharks. I mean regulated forms of credit that are out there in the market. Our process is, we encourage all applicants to fill in the benefits calculator, and we typically identify £210 a month that in benefits that they could be eligible for. So that's that sort of immediate impact. And in thinking about social impact, it's not just about saving people money versus the higher cost alternatives. It is about the wider social access issue. You're allowing people to repair their cars so they can go to work. You're allowing people to put a deposit on a nursery place so that can go to work. You are allowing people to take advantage of being able to be fully economically active should they choose to be. And the system is broken.
Yeah.
We look at the system differently, and we've shown that we can provide access to credit in a responsible, affordable, and fair way that is not being done by the system at large. And I think for all people interested in investing in this bond, that is the key thing here. We're doing something that is unique at scale and makes a huge difference to people's lives beyond simply the £1 in their pocket. It goes over and above that.
That's that's a great way to end this webinar. Thank you, Craig. And just to remind people, just to summarize, the offer is live on the FX platform and has been for almost 3 weeks. We are raising upwards of £800,000. It's an 8% interest rate. It's if ISA eligible, and it's a 3-year term. And we have 8 to 10 weeks to go. So as I said previously, please reach out if you have any questions. And I just want to thank Craig for coming onto the webinar and being very open and passionate about what Salad does. Thank you.
No, thank you, and thanks for your interest. And have a good rest of the day. Thank you.
Okay, bye everyone.
Bye bye.